This is a demonstration of exercise 1616B, earnings per share with a simple capital structure. On January 1st, 2021, Vermont Maple Corporation had 2,650,000 shares of common stock issued and outstanding. During 2021, it had the following transactions that affected the common stock account, and the instructions state into Part A to determine the weighted average number of shares outstanding as of December 31st, 2021. So I have a schedule that I'm going to use to compute the weighted average number of common shares outstanding at December 31st, 2021. First, we're going to go through each of the different transactions and calculate the number of shares that were outstanding and the restatements, and then we'll do the fraction of the year, and the spreadsheet will calculate the weighted average and we'll get the total. So we're going to start off at the beginning of the year with the shares that were outstanding at January the 1st, which the problem states is 2,650,000 shares. On March 1st, it states that we issued an additional 250,000 shares in exchange for land. So at that point, we had 2,900,000 shares. If you add 250,000 to 2,650,000. On April 1st, it states that we acquired 200,000 shares of treasury stock. So we know when we acquire treasury stock, those shares are no longer outstanding. So we would subtract those from the 2,900,000, and that would give us 2,700,000 outstanding shares. Then it states on July 1st that we issued a 20% stock dividend. So 20% of 2,700,000 is 540,000 shares. So when we add that to the 2,700,000 that we had, we now have outstanding 3,240,000 shares. But we also have to go back and restate each of the issues before that for the same amount of the stock dividend. So 1.2 for each one of these three before that stock dividend was issued. Next, it states on September 1st that we reissued 240,000 shares of treasury stock. So that means that we would add the 240,000 to the 3,240,000 that we already had. So now we're going to have outstanding 3,480,000 shares. Then it states on October 1st we issued a 2-for-1 stock split. So a 2-for-1 stock split is going to double the number of shares outstanding. So 3,480,000 times 2 is 6,960,000. But remember, we have to go back for all stock dividends and stock splits and do a restatement. So each one of the issues before the stock split, we would have to multiply those by 2. Now we're going to determine the fraction of the year for each one of these outstanding shares, because that is how you calculate the weighted average number of shares. You multiply the number of shares that were outstanding by any restatements and then by the fraction of the year before they changed. So we can see that in the beginning of the year, the 2,650,000 were outstanding for January and February before we issued the 250,000 shares for land. And those shares, the 2,900,000, were outstanding only for that 1 month of March. Next, we had 200,000 shares that we decreased because we acquired those as treasury stock. So the shares fell to 2,700,000 for April, May, and June. So that was 3 months. and then we issued the 20% stock dividend on July 1st, and those shares of stock, 3,240,000, were outstanding for July and August. Next, we reissued the 240,000 shares of Treasury stock, and that raised our shares to 3,480,000, and that was outstanding for the month of September. Then we had the 2-for-1 stock split on October 1st that increased the shares or doubled them to 6,960,000, and that was the last transaction for the year, and that was outstanding for October, November, and December, so 3 months. So now we have completed our spreadsheet. So how does the spreadsheet work? It takes the number of shares outstanding, multiplies it, in this case, by 1.2, and then again by 2, takes that amount and multiplies by 2 and divides by 12, and that gives us this number, 1,060,000, and you can see the formula up at the top. And it's the same way for each one of these. You multiply the shares outstanding by the restatements, then by the fraction of the year, and then divide that by 12. And that is the same way the formulas are for each one of these. And then to get the total weighted average number of shares, you add all of these together. So for this year, the weighted average number of shares will be 6,660,000 in the denominator for earnings per share. So we now know that figure, so we can move on to the B portion. And it says, assume that Vermont Maple Corporation earned net income of $8,352,000 during 2021. In addition, it had 200,000 shares of 9%, $100 par value, non-convertible, cumulative preferred stock outstanding for the year. Because of liquidity considerations, however, the company did not declare or pay a preferred dividend in 2020 or 2021, and it states compute earnings per share for 2021 using the weighted average number of shares that we determined in Part A. So to determine the earnings per share, we start out with our net income, which was $8,352,000. Now, we have to determine, are we going to subtract the preferred dividend from net income? Well, we know that whenever we have cumulative preferred stock, regardless of whether or not we declared or paid the preferred dividend, we still subtract it. However, we only subtract the current year preferred dividend. So they didn't pay the preferred dividend in 2020 or 2021, but we're only going to subtract the 2021 preferred dividend. So we need to calculate that amount. It's said that they had 200,000 shares of 9%, $100 par value cumulative preferred stock. So the par value would be $20 million, which is 200,000 times $100 par. And then we would multiply it by the 9%, and that would give us $1,800,000 as the dividend that would be for the preferred. And again, they didn't issue it, but we would still subtract it because it's cumulative preferred. Okay, so that is the numerator, 8,352,000 minus the 1,800,000, and then we would divide that by the weighted average number of shares that we determined in Part A. And that's what the formula does that I have in the spreadsheet, and that gives us earnings per share of 98 cents. In Part C, it states, assume the same facts as in Part B, except that the preferred stock was non-cumulative. Okay, so again, if the preferred stock is non-cumulative and the preferred dividend is not declared or paid, then we would not subtract it. So the numerator would just be net income, and the denominator would be the 6,660,000 shares. And earnings per share for Part C would be $1.25. The D portion states, assume the same facts as in Part B, except that net income included a loss from discontinued operations of $500,000, net of $300,000 in income taxes, and compute earnings per share for 2021. So we're going to use the facts or the information that we had in Part B. We calculated the earnings per share to be 98 cents, but now they're saying that included in this net income was a loss from discontinued operations. So as we know, whenever you have a loss from discontinued operations, you're required to break that out separately and show it separately in your earnings per share calculation. So the first thing we need to do is determine the earnings per share for the loss from discontinued operations. So we had $500,000 as our numerator, and then the weighted average number of shares in the denominator gives us 8 cents per share for the loss from discontinued operations. We know that earnings per share that we calculated was 98 cents, so we can back into the amount for income before discontinued operations by adding that 8 cents. So 0.98 plus 0.08 gives us $1.06 of earnings per share before discontinued operations. So our earnings per share would be shown as $1.06, a negative 0.08 because it was a loss, and then our net income would be 98 cents. And that is the conclusion of the demonstration for exercise 1616B.